Welcome to this episode on Create Your Real Estate Investing Strategy. So I'm actually recording this today, which is Friday, November 29th. It's the day after Thanksgiving, and so it's Black Friday. And so I decided to do this webinar and then turn it into an episode for people to reference in the future for a couple reasons. One is I'm very, very big in creating your real estate investing strategy, and just your strategy and your goals in general, I think is a very important thing. And something that I like to do is I like to focus on my wealth creation, my goals, and just the bigger picture items during this time of year. And I don't know why, but even on days like Black Friday, it gets me a little more amped up to do this longer term stuff, because I know the vast majority of people out there are, they're spending their day buying basically a bunch of stuff. And in my mind, a lot of times it's, I get gifts from a lot of people and I'm like, I don't need this. I don't need this. I don't need this. It's just, for lack of a better word, it's crap. I don't mean to offend anyone by there, but I'm a pretty simplistic person. And when I need something, I buy it. So I also don't time things on Black Friday. But it helps me focus. Hey, while everyone's out there focusing on spending money and consumerism, I'm focused on wealth creation. And I think playing the more important game for my retirement, for my family, taking care of my kids' college education, all that stuff. So I did this today because it helps me get more excited about it. I know I got a handful of people joining me live on the webinar while I'm recording this. So thank you guys for doing this instead of, typical buying stuff. And also, I'm just getting ready to do my goals. I always start writing my goals for 2020, reviewing my previous goals right around the end of Thanksgiving, between Christmas. That's when I usually like to focus on those items. So this is also helping me mentally kick off what I will be focusing on for my goals in 2020. So who am I? My name is Chris Lopez. I'm a real estate agent here at Your Castle Real Estate, and I'm an investor-focused real estate agent. That's all I focus on, is helping people buy rental properties. The other area I focus on is what I'm calling real estate financial planning. And that's more this longer term planning, not just going out there and helping people buy the specific property or finding a good deal in the current market conditions, but hey, what's the end goal? What's the plan? How do we build the blueprint? How do we build a roadmap to get from where you're at now to your end goal for where you want to get into real estate? So, and that's where a lot of this content for this next hour is going to go into, is just more of that longer term planning. So I'm going to share with you the way I look at things, some of my own personal numbers, what I've learned from working with clients, making my own mistakes. So my goal here is to give you a roadmap so you can go out there and start piecing together your own plan, and give you some specific action items throughout so you can hopefully do what you need to do to go out there and buy your first property, your next property, or hit your cash flow retirement goal in 10 years or 15 years or 20 years or whatever your goal is. So getting into it, I look at creating a retirement income from real estate in 4 phases. So the first phase is create your real estate investing strategy, create your real estate investing plan, your goals, all that stuff, what you want to call it. You have to have a plan. You have to have a roadmap to know where you want to go. Because if you don't know where you want to go and how you're going to get there, it's really hard to get there. I always go back to using Google GPS, or if you remember the days before Google, you'd use like the Thomas Map guides. You'd actually go out there. You have to most importantly know where you want to go, and then you start planning your route to get there. And even though all of us are going towards the same goal or the same destination, there are numerous routes to get there. Just like if you're driving into downtown Denver, well, there's numerous ways you can get into downtown Denver, depending on time of day, traffic, what roads you want to take, all that stuff. Same thing with hitting your retirement goals, and not just in real estate, but just in general. But we're going to be focusing on real estate investing and creating your plan. So the big part of this is going to be focusing on this first phase, is creating your real estate investing strategy. The second phase is, once you have your plan, it's time to go out there and accumulate properties. Great. The best plan is the executed plan. So I don't care how good your plan is, and I'm not a perfectionist. I'm not going to say we have to have every single detailed and minute and dollar figured out before we do anything. No, we'll get a plan, and you go out there and start executing it, because once you take one action item, your plan adjusts. Same thing with real estate. Once you go out there and buy your first or your next property, or you sit there for a year or two while you're saving up for your next property, things are changing. The market is changing. Your life is changing. So you always will have to come back and update your plan throughout this. So plan, and the second step is to accumulate properties. And then the third step is to start paying down your properties, so that can create your fourth phase, which is actually hitting your retirement goal and being able to retire so you can travel, quit your job, whatever your end goal is and what you want cash flow for. So the four phases, the way I look at it, phase 1 is your real estate investing strategy. Phase 2 is accumulating properties. Phase 3 is paying down the debt on the properties. And phase 4 is your retirement. So very briefly, looking at 2 and 3, accumulating properties and debt pay down. So from a very high level, it's your capital is always better spent accumulating more properties than paying down your debt if you need more properties to hit your end goal. And I'll talk more about that as we go through this, but just generally speaking, in most scenarios, until you hit the number of properties you need, your next dollar, or that dollar you have in savings, is always best used towards accumulating properties than paying down debt. I shouldn't say it's always best, but more often than not, it's best to accumulate properties versus prepaying your mortgage on one of your properties. So we'll talk more about that now or in the future, but I know a lot of times I get questions on that while we discuss this. So a note that this plan is really geared towards investing and not geared towards people building a business. And what I mean by that is this is planning, hey, I've got so much cash, and I've got this time, I've got these goals. How can I go out there and deploy my cash to achieve these goals? And by business, I mean if you're starting as a fix and flipper, a wholesaler, or a real estate agent, or you want to go out there and do BRRRRs, all those can be great ways to go out there and make money and build your rental portfolio, but there's a lot more variables on there, and it's much harder to plan. So this is all geared towards timeline and numbers, so we can back in the end goal with how many properties you need to get, and then get a rough calculation how much cash you need to get it. So this is really geared towards for people that have income coming in. Like a lot of my clients are business owners or professionals. They have jobs, and they know they invest in their 401k. They have other investments, but they also want part of their portfolio in real estate, but they don't want to start a new career. They don't want to spend 300 hours a year knocking on doors, hunting down a property. They just want to understand and know how to deploy their capital so they can meet their retirement goal. So this is coming more from that point of view. How do you go out there, invest your money to hit your end goal? So the very first thing you need to figure out is, what is your cash flow goal? We're all buying real estate because we want cash flow, we want assets, we want income, we want equity. What is that end goal you want so you can live whatever XYZ lifestyle that you want? So the way I look at it is, what is a total retirement cash flow that you need? And this is including Social Security, pensions, annuities, stocks, bonds, whatever else you have that'll be part of your retirement goal. Now, I'm not going to talk about those items other than just mentioning it, because I am not a certified financial planner and not licensed to talk about all that stuff. And plus, that's way too many variables. And frankly, there's a lot of great resources out there on how to calculate your retirement income for all those other areas, whether it's spending time on Google, reading books, or hiring a professional to help you figure that out. But when it comes to real estate planning, like real estate investing planning and creating a strategy, there's very few resources out there. There's no certifications. There's no industry. There's no certifications out there for people to help you plan that. So that's why we're going to focus on the real estate aspect of it. So once you have the global cash flow that you want for your retirement, then figure out, what amount do you need from your real estate investments? And so the most common goal I hear from people is $10,000 a month. I talk to, anywhere from 1 to 6 people a week, like having detailed conversations where we sit down and do an initial investment consultation and talk this stuff in detail. So I talk to anywhere from about 1 to 6 people a week. And the most common goal I hear is $10,000 a month. So that is what we're going to focus on and structure this presentation around, and creating a strategy is $10,000 a month, because that's what most people want. And if you are a little bit higher, a little bit lower, you'll still have a very good baseline to go out and figure out what $10,000 a month, or what you need to get $10,000 a month. So let me walk you through a few rules of thumb here on what you need so you can go out there and get $10,000 a month. So I always think of that goal in today's dollars, because we think, oh gosh, okay, so let's see, I'm 37 now, so my retirement age is hopefully about 55, so in about 17 years, or was it 18 years from now, how much cash flow do I need? Well, then you got to figure out inflated dollars and how much is a dollar in the future worth versus today. And I think it's very tough. You can do it, but just adds one more layer of complexity. And I find that muddies the water and gets people stuck in like an analysis by paralysis. Or I should say, what's that saying? Paralysis by analysis mode while they're trying to figure all it out. So a very simple way I look at this, a couple rules of thumb that I use, is think in today's dollars. If you were to retire today, how much money would you need or would you want from your real estate to cover your living expenses or X number of living expenses that you have right now? And why do I say that? Well, because rents are generally inflation-proof. At least here in Denver, historically speaking, they have been inflation-proof. And by that, when I say inflation-proof, I mean that as inflation goes up, which is the cost of living, rents also go up. So the Consumer Price Index, which is the government way of measuring it, I think the last 100 years or so, it's been right around about 3.1%. We'll just say 3% for simplicity. Well, Denver rent growth the last 30, 40 years or so, I forget the exact time frame, but a good last couple decades in Denver, our historic rent growth has been 4%. So we've been slightly outpacing inflation. So is there a chance that we will continue to outpace inflation? I think so, or at least I think so here in Denver, because we are a growing city. We have lots of people moving here. We have lots of businesses and jobs moving here, and that keeps rents and prices moving up. But for my simplistic modeling and the way I actually model for myself is I just assume rents will go up at inflation. And if I'm happy with those numbers and I can still achieve my goal, great. And if there's a good chance, and I think there is a good percentage chance that we will see rents outpace inflation the next 20, 30 years here in Denver, well, that's just going to be a big fat cherry on top that will, hey, if I retire with $13,000 a month in cash flow versus $10,000 a month in cash flow, yeah, you're not crying on my shoulder. I should say I'm not crying on your shoulder if that happens. So I think in today's dollars, and then I just put that going forward. I said, great, if I need to get this amount of rental properties, get this amount of dollars, but once I have that, well, they should keep pace with inflation. So the $10,000 today should be equal to $10,000 in the future. Now, it'll be a higher dollar amount, but it should be the same purchasing power. It would be like you having $10,000 today, even though it might be $17,000 when you retire and you have $17,000 a month in income, it'll buy you the same amount as $10,000 today does. So hopefully that makes sense. So another rule of thumb I use is what I call the 33% rule, or the 1/3 rule. I know a lot of people are familiar with the 50% rule, which I think comes from Bigger Pockets, or is a very popular rule of thumb on Bigger Pockets. And what the 50% rule says is that for every dollar of rent you get, 50 cents on the dollar will go towards your operating expenses, your non-mortgage expenses. So property insurance, taxes, property management, repairs and maintenance, capital expenditures, common utilities, snow removal, all that stuff. Well, that's a very broad rule of thumb nationwide. And for the Denver market, that's just way too high. And here's a way to look at that. Because if you're buying a place in like a Midwest state that's a great cash flow market, well, a lot of times their rents for a 3-2 place is $900 or $1,000. Where our rents for a 3-bedroom, 2-bedroom house out here is $1,800 to $2,300 a month. So when that water heater breaks in both the houses, when the roof breaks in both the houses, when it comes time to remove the snow on both those houses, there's usually not a huge cost difference between a water heater here and a water heater in another market. Now there might be a few dollars, the labor cost might be a few higher, all this stuff, but that water heater is not costing you, a lot of times those expenses aren't equivalent to 50% of the rents, because 50% of rents out here for that house would be like $1,000 a month. We're out there, it might be $450 or $500 a month. So there's a big, big difference on there. So from a very high level, simplistic rule of thumb, if you want to calculate this stuff out yourself and do some math yourself, I use the 33% rule, or 1/3, which states that every dollar that you bring in rent, about 33% or 1/3 of it will go towards your operating expenses. So your property insurance, your taxes, your management, all the other stuff that's not related to the mortgage. And the reason we look at it that way is because usually when people are buying properties, their main goal is not paying off the mortgage. But when it comes to wanting to retire in 10, 15, 20 years, well, having a paid off property with no mortgage is going to give you a lot more cash flow. So a lot of times we want to time paying off the mortgage with when we want to retire from, so we can maximize the cash flow. So that's the way I look at that. Is great. We got X amount of dollars today in rent, but once it's paid off and I'm still paying everyone and paying all the expenses, I should be able to take home this amount of money. So I use the 33% rule. Now, some places will be slightly higher. Some places will be slightly lower. But as a good starting rule of thumb, that's what I would start off with. And that's what I use myself for my own modeling and with all my clients. Okay, so getting to $10,000 a month, my next question is, okay, well, you want $10,000 a month. Well, is that $10,000 a month before all your operating expenses, after your operating expenses, before taxes, after taxes? What is $10,000 a month? Because I think $10,000 a month, I have a very clear image in my mind, which is $10,000 a month after all the operating expenses. But a lot of times people are like, well, I don't know. I just want $10,000 a month. And so most people mean $10,000 a month after all the expenses, but they don't have that clarity yet. So that's another reason I'm sharing this with you, so you can, when you say I want $10,000 a month, you can model it out and take the couple extra steps to really understand what $10,000 a month is and what you need to get there. So using that 33% rule, if I want $10,000 a month in my bank account after I pay everything off, well, then I need $15,000 a month in gross rents. So if you take $10,000 a month and divide it by 0.666, so 2/3, it'll give you $15,000 a month. So if I have $15,000 in rents before any expenses, well, then we can take 1/3 out, which is $5,000, and now I'm left with $10,000 in income, which is having your properties paid off. So another word we can use, and some of you people or some of you listeners out there, this will make the light bulb go off, and this will probably confuse some other people, but that $10,000 a month of income after operating expenses, that's the same number as your net operating income. If you've done any property analysis or understand the basics of property analysis, you're familiar with the term net operating income, or NOI, for short, NOI. And so what is the definition of NOI? Well, it's your rents minus your vacancies minus your operating expenses is your NOI. So as you're analyzing properties, or if you have spreadsheets you're going to use that, you can also just exchange the $10,000 a month income with $10,000 income of paid off properties with my goal is $10,000 a month in net operating income. And so I usually look at things as an NOI standpoint, just because I analyze properties almost 7 days a week. So I'm always looking at NOIs, and that's just how my brain thinks. So I'm going to be using those phrases interchangeably. So I want to give you that heads up so you don't get confused. So they are the same thing. If I say $10,000 income in paid off properties, that's the same thing as $10,000 income as your NOI, as stated on a spreadsheet or some other type of like property analysis tool. So with that in mind, how many properties do you need? Great, we want $10,000 in NOI, but that really means we need $15,000 in rents today. And then once those are paid off, we'll have about $10,000 in income in today's dollars. Well, there's no magic number. It depends, which is the answer for a lot of things. It depends, but it really does, because are you buying single family or multifamily? Because buying one property that's a house versus one property that's a multifamily is going to have a very different impact on your NOI at the end of the day. Is it a 1-bedroom or is it a 4-bedroom? What part of town is it in? All this stuff is going to affect the rents you get, how expensive the properties are, and how many properties you need. If you're buying all single-family homes and I'm buying all fourplexes, well, I will probably need 3 properties and you may need 7 to 9 properties. And we're both right. We're just taking a different route to get there. So you can't say, hey, I need 10 properties, because 10 fourplexes is very different than 10 condos in Aurora. So I use 2 ways to calculate the number of properties needed. So I'll go through these really quickly so you can understand it and get an idea for how you want to calculate it. So method 1 is just using current rentals that you own or that you're seeing other investors have, or just from the case studies we talk about in the podcast here all the time, using current rentals or your expected rentals and divide that into your goal. So we often talk about the best cash flowing places in Denver right now that we consistently see are 3-bedroom, 2-bathroom condos in Aurora, and they rent for about $1,800 or $1,850 a month. So if my gross rents goal is $15,000 a year, 15,000 divided by 1,850 gives me 8.1 properties. Well, I can't buy a tenth of a property, so let's round up and say I need 9 properties. So that's one rule of thumb on how to use it, or give you a roadmap for how many properties you need to buy. Method 2, and this is a little bit more advanced, but this is the method that I prefer. So this is taking the income goal after your properties are paid off, which is your NOI. And then if you know what NOI is, you probably are familiar with cap rates. So what is a cap rate? Well, that is the going rate for what properties are trading for in Denver. So the way you figure out purchase price, and this is the way a lot of times investment properties are, the values are determined and they're sold on it and underwritten. So the purchase price is equal to the net operating income divided by the cap rate. So if you have a $10,000 a month goal, that means you need $120,000 a year in net operating income. So take $120,000 divided by a 6% cap rate, and that means you need $2 million in properties. Whether that's condos or homes or multifamilies, you need about $2 million in properties. So why do I use a 6% cap rate? Well, that's a middle-of-the-road number right now we see as far as cap rates in Denver. And some of the smaller properties, like the better cash-flowing condos and townhomes we buy in Aurora, those are anywhere from like a mid-6 to a mid-7 cap rate. Well, if you're looking at multifamilies, well, we're looking anywhere from a low-5 to a low-6 cap rate. And then single-family homes anywhere from a mid-4 cap rate to a mid-5 cap rate. So depending on what type of property you're buying, you're going to see different cap rates. But as a rule of thumb, I like to use 6% cap rate because we can go out there and find properties that are 6% cap rates. So if you use give you some ideas, if you use a 5% cap rate, that's $2.4 million in properties you need. And if you do a 7 cap rate, that's $1.714 million in properties. So, I mean, there's a difference there, but not a huge difference where if you buy a couple properties below a 6 cap rate or a couple properties below a 6 cap rate, it's not going to have this dramatic effect on you hitting your retirement goal. And I'm also sharing this because a lot of times people want to invest out of state in Denver and like, oh, I can only get a 6 cap rate here, but man, I can get a 7.2 cap rate out of state. Well, 2 things. I'm like, number one, you can get a 7.2 cap rate here in Denver. Secondly, like, is it really worth that hassle and risk for a 1% cap rate point to invest out of state? I don't think it is. And you look at it from like a retirement planning goal, it's not really that important. So if you don't understand the calculations of purchase price equals net operating income divided by cap rate, don't get lost in the mud there. I just wanted to show you one way to use it. And stick with this number right now, that if you want $10,000 a month in income, you need to go out there and buy about $2 million worth of properties today, plus or minus a couple $100,000 in property value, depending on a couple variables. All right, so moving on. Now, how do we go out there and acquire that $2 million worth of real estate. So looking at this from an investing standpoint, and this is not from getting, doing the BRRRR strategy or knocking on doors and finding killer deals. It's just, I need X amount of dollars to buy X amount of real estate. So from a down payment perspective, 20% down payment of $2 million is $400,000. Now, you could be buying one $2 million building, or you could be buying a bunch of places. I'm just saying you roughly need about $2 million worth of real estate, and that down payment can be on one property or spread across multiple properties. Now, very few people have $400,000 sitting around right now to go out there and buy real estate, so you might be putting $50,000 down, $70,000 down at a time to buy properties as you build up to it. But overall, this would be about the total amount of money you need from a down payment perspective, plus you have closing costs and some other fees associated with buying real estate. So I understand it'll be a little bit higher, but this is just to conceptually give you an idea of how much money you need to go out there and buy it. At a 25% down payment, you need $500,000 or $500,000. At a 5% down payment, you only need $100,000. So that $100,000 or that 5% down payment, if you're doing the house hacking or nomad strategy, well, you can buy a lot more properties with a lot less money down because you are using these great government loan programs for putting 5% down on a property. Now, in my living situation with my wife, my kids, my dogs, doing a nomad every year, every couple of years is just out of the question. So I am doing what most investors do, which is doing the traditional landlord route of putting 20 to 25% down on properties. So to acquire $2 million worth of real estate, depending on your situation, you're going to get anywhere from about $100,000 to $500,000 in down payment, plus some closing cost. So how do you go out there, now that we know roughly the amount of money we need, roughly how many properties we need to buy, the total amount we need to get, how do you start putting that plan together? Well, I'll go through these next couple of steps that I follow and I take my clients through to start putting their plan together. So the first thing is look at your personal savings rate and your budgeting. That's always the very first thing to look at, I think, no matter what you're doing. Now, generally, I don't really go into much detail with this on clients because there's a lot of it's just common sense, and there's a ton of information on Google and books to read where we can figure out all this stuff, or you can figure out this stuff on your own. Now, when it comes to creating a budget, it can be as simple or as complex as you want, whatever works for you. I know some people, they do the envelope system. They put cash in envelopes every month. Some people have incredibly detailed spreadsheets. And it's amazing how much that they, get down to their dollar every month based on groceries, and entertainment, and gas, and insurance. Every time I try to do any really type of tracking, I can never do it. So I'm a very simple person when it comes to budgeting. I say, great, my overall goal this month is to spend this amount of dollars. I just want to make sure that we're just not wasting money. And by that, I really focus on not having excessive, car payments. We don't eat out a whole lot. We don't do a lot of stuff. But as far as trying to shave $50 off my grocery budget, I just find that is not a great use of my mental energy. I'd rather spend that time focusing on how can I go out there and make more money versus saving a few dollars. So there's no right or wrong. It's whatever works for you, the way your brain thinks, and obviously your financial situation. And then you need to set up a system for saving money, which is your monthly savings rate. So your budget comes first, then your monthly savings rate. And again, this can be as complex or simple as you want. So the way I look at it, again, I do things pretty simple, and I don't, if I save a little bit less one month or a bit more one month, I really don't care, because if I don't, I didn't save, I saved $70 less this month, well, that's going to have zero impact on my retirement one day. So I don't get stressed out about small things. So the way I have my budget broken down and my savings broken down is, is that both my wife and I work. My wife is veterinarian, so she's got a pretty standard schedule and a pretty standard, paycheck. Nice W-2 paycheck she has. Well, we know what she gets every month, roughly within a really good ballpark. Well, I'm a real estate agent. I'm 100% commission based. So my income changes every month, plus my expenses go up and down. So the way we look at it is her income covers our living expenses. So it pays our mortgage, pays our health insurance, handles student debt she still has, pays our groceries, pays our insurance cost, all that stuff. And then my income, or the vast majority of my income, is geared towards growing my real estate business and going out there and buying, investing in the stock market, investing in rental properties. So the better my business does, the more money I have. And I've got my formula for how much money I make each month. I take X percent of that and put it into a savings account. That is our investment opportunity fund. And it's way more than $70 a month. I have a very big goal to put in there every month because that money funds all of our investments. Now, I would say, her salary covers the vast majority of our expenses other than, hey, big bill here, vacation here. Yeah, I chip in then. So it's not perfect, but it's a good enough roadmap on the way we separate bank accounts, we separate credit cards, so where it keeps it simple and we can consistently save each month and also keep our budget under control. So that works well for me because it's very, very simple, and that's what I like. So set up your budget, set up your system for saving money, and then set up that plan so you can go out there and do it. Because at the end of every month, or at the beginning of every month, right around the 5th of every month, I look at all of our expenses from the past month. And that's mostly from my business expenses, and I say, great, here's what I have, here's what I'm doing. All right, I'm putting this aside for our investment fund, which then funds your real estate investing, stock investing, all that good stuff. So the next thing to ask yourself is nomad or house hacking an option? If it is, definitely do this. And I mean, I have a serious conversation about this and a serious thought about it too, because a lot of times I talk to people and it's just, they brush it off. But really look at this because it is an absolutely powerful way to acquire properties for very little down and get some amazing financing terms. I'm buying properties at 20, 25% down, where you can buy properties at 5% down, or sometimes even lower if it's your first time buying properties. Well, you're putting a lot less money down than me, so therefore you can buy properties a lot quicker or save a lot less money. So it's a very, very powerful option. Now, I'm not saying you have to do it, 10 times with 10 properties. Even if you do it once or twice, it can have a big impact on your income. But the most important thing is, how can you make this work for your lifestyle? And I don't nomad, but I house hack because I said I keep my budget really simple. I don't worry about, oh, great, I spent $8 at Starbucks this week where normally I spend nothing. I just don't care, and $8 is not going to impact my retirement one day. But, our living cost is a big percentage of our monthly budget. So as many of you know, my wife's mother or my mother-in-law lives with us, and so it helps reduce our living expenses. And then also she helps a lot with daycare. So we're saving $1,500 to $2,000 a month on daycare. Well, $2,000 a month, that has an impact on me. Buying a couple cups of coffee a month does not have an impact on my lifestyle or retirement one day. But $2,000 a month does. So how can you make it work for your lifestyle? Because usually times people think about nomading, they have to move every single year for 10 years. No, I mean, if you want to be like the textbook example, yeah, do that. Or house hacking, go buy a house and get 5 roommates. Well, yeah, that's kind of the normal example we see. But depending on where you're at, see if you can make any of these options fit into your lifestyle because the impact can be so, so powerful. So I just talked about that bullet point. Okay, so even doing one nomad property can go a long way. So I've got a great example on buying one nomad property, and I got a great example on buying one house hack property. If you want the details of house hack property, go read my goals where I post every year. But we consistently save probably about $2,500 a month in cash flow. And guess what? That's $2,500 a month that goes into our real estate investing fund. That's a lot of money. And I've done one nomad property, and I've got a great example on how this can go a long way as well. So, and I did this nomad property years ago before I knew what a nomad property was. Okay, so this example is a 3-bedroom, 2-bathroom condo I bought for $67,000 in 2011. I bought this in Reno, Nevada, and I did buy it at the best time in the Reno market. And that was just part of luck because I knew nothing about real estate. I was not investing back then. I think back then I was actually still wasting time trying to do some foreign currency trading, and I should have bought more real estate back then instead of doing day trading nonsense, but whatever. Now I got a great example for this. So I purchased a 3-2 condo for $67,000, and part of the reason I bought that was hey, I can buy a place. I don't see I'll go any lower. It's cheaper than my rent. I travel 7 months out of the year, so at least, I'm paying a little bit more for a storage unit, but I own a place. It's a win-win. So I used it as my home base for like 3 years or so. Right around 2014, I turned to a rental property. Never made amazing cash flow, but it would cover the bills and make $100, $200 a month in cash flow. I actually never once took money out of that checking account for any type of distribution, just kind of kept building up. Then I used it once to do a light remodel on the place, a few things like that. But there was never any significant money in there from the cash flow. And part of that was just because the rents weren't super strong in Nevada, and I also bought it for 0% down on a 15-year mortgage, so I had a higher mortgage than if it was a 30-year. But in May of 2019, I sold for $229,000. So I had a huge equity build, and when I sold it, rents were about $1,300 a month. So equity skyrocketed, rents increased a couple of dollars a month over those couple of years. So it did not make sense to keep it as a rental at today's price in rents because it would be like a 4% cap rate. Plus, it was in Nevada, and I did not want anything out of state. So I sold it after paying off the loan, paying the realtor fees, and all the closing costs. I walked with about $172,000. And that was my down payment in a 1031 exchange into a fourplex here in Westminster for $850,000. So the condo rent was $1,300 a month. The new fourplex rent is about $6,600 a month. So let's run through an example and figure out which one of those gets me closer to the $10,000 a month goal. So the condo return, and these would be all annual numbers, the cash flow after all the expenses is just under $3,000 a year. And then the true cash flow, which is the term we use for cash flow plus your tax benefits depreciation, is about $3,500 a year. So, I mean, that's good money, but in reality, $3,500 a year is not going to make or break anything for me or be going to allow me to live some lavish retirement plan. But once it's paid off, well, now it's about $10,500 using the 33% rule. So $10,500, okay, that's a good chunk of money. But again, that's not going to have a significant impact on my retirement. And in terms of my overall goal of making $120,000 a year, that's 8.7% towards my goal. So not even 1/10 of the way towards my goal. So definitely a good step, but nothing huge. Now looking at the fourplex return, the cash flow today is just over about $12,000 a year. So just a little over $1,000 a month. So I'm making more cash flow today, even though it's a new property, more expensive property, a new loan that's being amortized. I'm making more cash flow today than I was with a previous rental that I bought for way cheaper. My total true cash flow is almost $19,000 a year. So now we're getting some pretty good money right now where that money I take, it goes back into my real estate investing opportunity fund to help me buy my next property or my next stocks that much quicker. Now, using the 33% rule, when the property's paid off, I'll be making $53,000 a year, or I'll have an NOI, a net operating income of $53,000 a year. Well, that's a big chunk of money right there. I mean, $10,000 a year, I always take that, but $53,000 a year, everyone's going to take that over $10,000 a year. And that is a significant step towards the goal of $10,000 a month. So $53,000 divided into $120,000, that's 44.2% towards my goal. Okay, now we're talking some serious stuff here. So I'm sharing this goal with you because even if you have the opportunity to go do like one nomad property, one or two can have a huge impact down the road for you to go out there and achieve your goals. So I did that. I'm very glad that I did that. So if you can do it with your family or convince your spouse into it, definitely have a serious conversation about this and don't blow it off. That's the point about this example. All right, so the third thing I look at is there any available equity? And equity is what you own in the property. So it's a property value minus any loans on there equals your equity. So your equity is your real estate piggy bank. So I went through that previous example of how I had a huge equity bill in the rental property, sold it, and increased my return on there. And look at equity in your primary residence and or any rental properties you have. And so you got three ways to go out there and extract equity from your properties. You can sell the property, You can get a HELOC, which is a home equity line of credit on the property, or you can do a cash out refinance on the property. So if you're pulling equity out to go out there and buy more long-term rentals, usually selling or a cash out refinance is the best route to go. A HELOC is great for short term, but if you're investing this money for a long-term play, I don't think HELOC's the best way. Now, if you're doing a HELOC to fund a fix and flip or a short-term project, or to be a down payment on a BRRRR property, then refinance out in 6 months or 10 months, yeah, HELOC can make a lot of sense. But if you're like me, where you just want to go out there and buy rental properties, I have not found HELOCs make a whole lot of sense, but it is one option to go out there and get equity. So I went through one example of selling the property. Now I'm going to actually do a totally different example, and this is another real one. I'm going to walk you through very quickly the cash out refinance I just completed my primary residence and why I did that. So I just closed a cash out refinance a couple weeks ago, and I got about $106,000 plus or minus a few bucks from the cash out refinance. So why did I do that? Not to fund home improvements, not to take a vacation to Fiji, not to buy a Tesla or some car. I got it out and I put it into a dedicated bank account that will not be touched until it's wired in for a down payment on one property or a couple down payments of a property. Because if I take that $106,000 at a 20% down payment, that'll buy me $530,000 worth of real estate. So I can go out there and buy a couple rental units for that in the Denver market. So assuming a 6% cap rate, $530,000 times a 6% cap rate gives me an NOI of $31,800 or $31,800 I can expect once the property's mortgage is paid off. So if I'm able to go out there and buy more properties and get about $30,000 a year in income after my mortgage is paid off, well, $32,000 or $30,000 divided into $120,000 is about 26.5%. So this will get me about 26.5% towards my monthly goal. And as a quick note, yes, even with a higher personal monthly mortgage payment, this still makes a lot more sense. I think my mortgage payment went up about $350 to $400 a month, but I can go out there and make way more money, and I'm getting myself a big step closer towards my retirement goal. So I'll go into a lot more details on that later, but I just wanted to touch on that because that question always comes up. So a lot of times when people are starting out with nothing, they say, wow, getting $10,000 a month, that's a long way to do it. But $10,000 a month is very achievable. And just as using these two properties as an example, with very, very little money out of my pocket, I'm actually a good step towards that $10,000 a month goal. So 2 transactions got me a good chunk of the way towards that goal with minimal money out of pocket. So here's a table on the screen that just shows these numbers. So that Nomad condo to a fourplex bumped up my NOI to $53,000 a year, which is 44% towards my goal. Doing a cash out refi in my primary residence gives me an almost $32,000 a year NOI, which is about 26.5% towards my goal. And then the total amount of that is a net operating income of about $85,000 a year, which is like 70% towards my goal. And a question just came up. Someone said, I can't understand what a BRRRR property is. My fault. I forgot to explain that. So BRRRR, B-R-R-R-R, so 1 B as in boy and 4 R's, stands for buy, rehab, rent, refinance, and repeat. So the strategy there is you go out there and you buy a property. So you're buying a property that's under market and undervalued. We can go on there and do some forced appreciation by fixing up the property, get the tenant placed in there, and then you increase the value so much that you can take your initial down payment on there. So that's usually people using cash or a HELOC or a hard money loan. So a short-term loan to go in there and fix up the property, then stabilize it, and then have a dramatic increase in value, then pull the money back out. So from very high level, if you go buy a property for $240,000, you put $40,000 in there to rehab it, and then it appraises for $400,000. You can pull out your original money or pay off your original loan, and now you get a rental property with no money down or very, very little money down. So that's what a BRRRR property is. It's just a strategy for going out there and accumulating properties. All right, so when you step back and look at this, getting $10,000 a month, okay, that actually looks doable. But a couple things in here. What's going on? Well, one is I'm practicing patience. I bought a place 9 years ago, and that's when I just saw this huge step up in getting a huge NOI, which will have a significant impact in my retirement goals one day. And like a lot of people here in Denver, if you've owned your home for a while, if you bought it 3, 4, 5 years ago, you're sitting on equity. Or maybe if you bought rental properties, you're sitting on equity. So make sure you're looking at that and realizing, wow, I can take that equity and go out there and buy more properties and have a big impact on my retirement goal. So I want to give you an alert to a new resource out there. And actually, at the time of this recording, I'm publishing it as I speak about this. But by the time this podcast is published, all these will be published for you to review. And that's called the Investment Property Analysis course. It's a 6-part course that goes through how to estimate returns on initial investment, how to look at different ways and measure your equity, how to pull it out, and give you a lot of details on how you can go out there and do those 2 scenarios I just did. And it uses those 2 scenarios as case studies and goes into full detail. So if you're like me and have any examples similar to that, make sure you go through that course, because I touched on these 2 examples very, very briefly and not in a lot of detail. But if you want to understand the numbers, go check out the investment property course. So there's 6 parts to it. The first one is the 4 returns in real estate, how to measure it. The second one is how to use the rental property spreadsheet. The third is calculating your return on equity. The next 2 are examples of tapping into your primary residence equity. Should you refinance it? Should you sell? Or should you convert it to a rental? And the last one is a detailed case study on refinancing my primary residence and the step-by-steps I did to actually go out there and refinance it. So you can grab that in the show note links or go to denverinvestmentrealestate.com/IPAC. And IPAC is short for Investment Property Analysis Course. So it's IPA with a C put on the end there. All right, so a fourth way to go out there and get funds to go out there and buy real estate is to use your IRA or your 401k money. And there's 2 ways you can tap into this. And personally, I'm not a fan of either for direct rental ownership. I have these conversations on a regular basis with clients, and more often than not, I talk people out of using the money, and therefore I'm talking myself out of business because I don't get a commission on them not buying properties then. But I always want to give people the best advice, and when I say, hey, here's why I would not do it, here are some numbers, and here are the things to keep in mind if you're considering it. Because if you go on Google, well, a lot of times you're getting fed information from IRA companies, and they are biased towards you using the money because that's how they make their money. So here's why I don't like it. I'm going to touch on these really, really briefly, but I want to just touch on it because this comes up a lot. So option 1 is you can just pull out the money from your IRA or 401k. But generally speaking, you're going to have a 10% penalty. If it's a traditional IRA or 401k, you'll have a 10% penalty. If it's a Roth IRA, you generally don't have that penalty, but talk to your tax advisor or Google it to figure out those details. Plus, you'll owe income taxes. Again, this is on traditional IRAs and 401ks. So you're going to take a big hit right now to penalties and taxes. So you're losing a big chunk of cash now lost to taxes that you can't use to invest, whether it's in real estate or the stock market. So if you pull out $100,000 from your 401k, well, 10% of that will go towards a 10% penalty. So $10,000 you're lost there. And if you're in the 20% tax bracket, which is probably, say 20% tax bracket, well, another 20% of the $20,000 goes towards taxes. So you pull $100K and you'll have about $70,000 left over to invest with. So make sure you talk to your tax professional or your CFP to understand those numbers. But I don't like it, and I want to do it myself. The second option is using a self-directed IRA or 401k. Now, these are not your typical retirement investment vehicles you get through your through your company, or if you go online and set up one. These are not your typical ones. These are special ones that allow you to go out there and invest in other assets besides the stock and bonds market. So these are special custodians that can handle you buying other assets. So because of that, there's more paperwork, there's higher fees, and there's just more maintenance to be aware of that. So make sure you know about that. And if you've heard me a few times, you know I'm like a keep it simple, stupid person, and I like to keep things simple. So that's one major reason I don't like to look at it. Another one is you have to keep into mind additional taxes. I won't go into details on them, but it's UBIT, UBIT, and UDFI. And these are taxes that you can impact you once you go out there and buy real estate with a loan. And then that is additional taxes you may owe. And then also that is usually additional tax preparation that you need to pay for. And that's not a real common thing. So that's not something you go to H&R Block and they do it for you for $20. You're going to a specialist where it's going to be a few $100s at least to do those tax returns for you, generally speaking. And I've talked to a handful of investors where, great, they've been doing it for a couple years, and then year 3, year 4, year 5, they get notified by the IRS, oh, you owe a bunch of UBIT back taxes, and then it's a big chunk of money and additional headaches. So make sure you're aware of it and you understand all the details on there. The other thing to keep in mind for traditional IRAs and 401ks is that you have something called RMDs. These are required minimum distributions, and these are rules set in place by Congress and the government so they can get their tax revenue from you. Because when you put money into your IRA or 401k, it's tax deferred. So if you put $10,000 in it this year, the government is not taxing you. They're not putting income tax on that money today because they say, we'll take that money, we'll get our taxes once you pull that money out in the future. So to make sure they get that money, they have required minimum distributions starting at 70 and a half years old. I don't know where they got the half year from, but that's the rule. And then every year it increases, and there's a table associated with it. So Google it if you want to see it and talk about it. But just realize if you own a bunch of real estate or all your retirement plans are in real estate, and when RMDs kick in, it actually can force you to sell the property. Because the government does not give a damn if you're in stocks or in real estate or whatever. They say, oh, you're this old with this life expectancy, your total retirement accounts are this amount of dollars. Oh, you are required to distribute this year X amount of dollars. Well, if you're required to distribute $50,000 that year, but you only have $30,000 in your account, well, then you have to sell one property to fund the other stuff. So it can force you to sell when you don't want to, or force you to sell when it's not an ideal time to sell in the market. So make sure you're aware of that. The other thing is you get lower leverage due to the type of loans you get in these vehicles because these are non-recourse loans. If I go out there and buy a property in my self-directed IRA and I default on there, the lender can't come after me because the 401k, the IRA, they are its own entity. So they cannot go outside the plan to force me to go out there and pay things. So even if you buy a property in LLC, you're still personally guaranteeing it. They're still underwriting you as a borrower. Well, if you're buying it as a 401k or IRA, they're only underwriting your plan. Well, because of that, they have to give you a non-recourse loan, and a recourse loan is one where they can come after you because you personally guarantee it. So a non-recourse loan is going to have lower leverage, which means a higher down payment and a higher interest rate. So to give you a quick example, a lot of times right now we're buying multis with a 20% down 20% down payment, right around a 4.25% from First Bank or other local banks around here in Denver. So the other month we talked to him because we had a client that wanted to do a self-directed IRA loan, and First Bank minimally require about 35% down, and typically the way they underwrite the property, and won't go into 10 minutes of details on there, typically ends up being more like a 40% down payment, and then the interest rate's usually about anywhere from a half to 3/4 point higher. So while we're buying a property at 20% down, a multi at 20% down, 4%, if we did through a self-directed IRA, it's going to be probably 40% down, maybe high 30% down, and an interest rate in the high 4s. So lower leverage gives you a lower return. So these are the main reasons why I'm not a fan of using IRA or 401k money for direct rental ownership. I have 401ks, I have IRAs, traditional and Roth, and all those are in stocks and bonds. I don't do any self-directed stuff because I don't like I want the simplicity of things. So I don't do anything fancy. I do all mine with stocks. Now, if you have but I also don't have millions and millions of dollars, tucked away into a 401k. If you've got a lot of money or do you want to invest in real estate, maybe investing in syndications or doing partnerships through there or lending money out as hard money loans will be the better way. I just don't think these are the best vehicles for doing direct rental ownership, but you can use them for other ways to invest in real estate, just not directly. And by direct, I mean you get the loan, you put the down payment down, but if you invest as an investor, you may want to consider that as well. That's not my specialty, but I definitely always tell people, hey, if you want to utilize that money, look at doing it that way too, and I would put my focus towards there versus trying to buy a property at 40% down. Because a 40% down payment does not get me excited. All right, give me a second here. I need to get some water and some coffee. Gotta stay caffeinated while we do these. All right, so the fifth way to go out there, or the fifth thing that some people may or may not consider when they want to start getting capital and money and a plan together for buying real estate, the common thing is here, as I'm going to flip or wholesale. Those are the two most common things I hear. Great, I'm going to flip or wholesale to go out there and build my rental portfolio. The next common things are the BRRRR strategy, the buy, rehab, rent, refinance, repeat, or becoming a real estate agent to fund the rentals. Now, I'm not against any of these methods. They can all be great methods and a great way to grow your real estate portfolio. But understand, these are not investing. These are starting a business. It's the equivalent to, if you look at the stock world, putting money every month into your 401k where they just automatically deduct 5% of your paycheck, to day trading. Day trading is a business or a job where your efforts are directly impacting your returns and you're guaranteed squat. And you have to spend time and energy into doing it. Where that automatic withdrawal, you have to spend no time in there. So I look at investing in real estate similar to that. Now, buying a rental property takes a little bit more time and hands-on than just having an automatic payroll deduction, but you also get a much better return, typically speaking. So it's a business, not investing. And I don't know what all the like success and failure rates are for all these different categories are, but I'm guessing for all of them, it's a 90% plus failure rate. I know that to be true for real estate agents. There's a huge failure rate for agents. If you look at that, hey, someone got their license now, who still has a license 3 or 4 years from now, I think the stats usually, it's somewhere between 10 to 20 or 80 to 90% of people don't have their license after somewhere in that 2 to 5 year time frame. And just talking to people that are flipping and wholesaling, I talk to a lot of people every week, or people that email me, I'll get into flipping or wholesaling, and then hardly any of those people ever do anything. And that's just a combination of it's hard, it's tough work, and it's a business. Same thing with BRRRRs. It's just tough to do. I'm not against it. I mean, I became an agent to go out there to fund my real estate. But before I became an agent, I did a fix and flip. I made $25,000 and realized I don't like fix and flips. And then I tried wholesaling. I was actually helping a friend in Las Vegas wholesale. And I was like, wow, wholesaling is a lot harder than I thought. I don't want to go down that route. Then I became an agent. And I became an agent because I needed new income. My other businesses, it was time for me to move on. And then I figured while being an agent, I can learn and I can network. I can build my knowledge base up. So if you want to go out there and do one of these strategies, if you want to flip, wholesale, BRRRR, agent, I have nothing against that. But be realistic and realize that's a 2 to 5 year plan and there's a high failure rate. But I talk to so many people that are flipping and wholesaling, but then they're renting a house or renting a room somewhere. I'm like, okay, well, go buy House Hack. Go buy Nomad property. Go buy one property because you have to pay rent or have to pay a mortgage. Go buy a property and get someone else's rent to pay it for you. And if you don't want to, I don't understand that attitude because that is a guaranteed path towards investing. Where you starting a wholesale business or an agent business, that's not a guaranteed path towards investing. A lot of stuff has to go right with a lot of work on your part to go out there and make that income come true so you can go out there and buy those rental properties. So if you are doing one of these methods, great. House Hack to reduce your expenses. Nomad a few times to start building a rental portfolio. But start thinking about this before you go out there and quit your job to become a full-time wholesaler or flipper, because if you're a brand new wholesaler or brand new flipper or brand new agents, lenders usually don't like that. They want to see 2 years of income history if you're self-employed, which is what you are doing these strategies, or a good W-2 job. So keep all that in mind. I'm not saying don't do this, But I'm saying do this while you're implementing your investing plan, which is either buying rental properties or go out there and buy nomads and house hacks. All right, so those are the ways I look at things to kind of getting your cash and your initial plan together for acquiring properties. The next area we'll talk on is your financial foundation. So your financial foundation is just getting your personal house in order so you can go out there and buy properties and then buy them for the long run, because you know what the key to owning rental properties is to not losing them if the market goes sideways, if you have a bad tenant trash your place, you lose your job or have a health emergency. As long as you hold the properties over the next 20 or 30 years, you're pretty much guaranteed to make good money. If you lose them in year 6 or year 2 or year 10, well, you got some problems on hand. So here is what I personally do, and I recommend my clients when I talk to them. Keep 6 months in personal reserves. This is not real estate. This is your personal emergency fund to cover your living expenses, your mortgage, all that stuff. Now, depending on your living situation, it might be higher, might be lower, but 6 months is kind of always the rule of thumb for financial planning. So 6 months in personal reserves. We usually keep about 6 to 9 months in our personal reserves. Plus, since I have a business, I keep about 6 months in reserves for my business as my real estate agent business, because, hey, some months I make more money, some months I make less money. So I want to make sure I got reserves in there to keep things going. So a lot of you guys have W-2 jobs. You don't need a business reserve, but you need a personal reserve, and you'll need a real estate reserve as well to handling those curveballs. So here's my rules of thumb based on what I know about financial planning, based on the modeling I've done, based on the numbers I understand, and based on talking to a lot of investors that lived through the crash 10 years ago. And these are people that survived it and people that lost everything. Keep 6 months of PITI, which is your your principal, interest, taxes, and insurance. So it's basically your mortgage payment with the monthly escrows of taxes and insurance, or $10,000 for the first 3 properties. So 6 months of PITI or $10,000, whichever one is greater, for the first 3 properties. So that might sound pretty conservative, and it probably is. I see very few people recommending this, but if a tenant trashes your place, or you get tenant on cash flow, or a couple bad things happen at once, again, the key here is to not lose your property in year 2, but hold on to it. And I feel this is what I personally and I recommend to all my clients. So keep 6 months of PITI or $10,000 for the first 3 properties. After you have 3 properties, I think it's time to review to determine a new appropriate reserve amount. Because if you have 3 properties, well, once you buy your 4th, 5th, 6th, you probably don't need to fund each one of those properties with $10,000 a month or 6 months worth of PITI. Because what's the likelihood of all 5 or 6 of those properties being vacant for months at a time, or having all 6 properties burned down at once, or tenants trash all 6 properties at once? It's pretty low in my book. Now, of course, it always could. You could hit the unlucky jackpot, but I think that's, in my mind, that's like, yeah, we can always plan for the worst. But this, for me, is the right balance that fits my risk profile. So after those 3 properties, I think you're diversified enough, because if you've got, let's say, $40,000 in savings between 3 properties, well, they might say, great, I got $40,000. That goes in my general real estate reserves account, and now I own 5 properties. Well, I'll just keep, I either run them all from that one account, or I'll keep one checking account for each with, 1 month's worth of payments in there to handle mortgage and an operating account. But I got $40,000 in reserves, because all those properties should be cash flowing. So if one property goes down, well, you'll have time then to pivot and figure things out. And that's why I say 3 for the first 3 properties, 6 months of reserves, because if a lot of bad things happening at once, whether it's your job, the economy, the market, a couple properties go bad, that will buy you time to come up with plan B so you can sell the property or do what you need to do to get in the right position, or get out of one property, handle the other 2 properties, and hopefully not force you into a short sale, racking up credit card debt, all that stuff. And so when I say reserves, I mean liquid. Reserves are liquid. So I keep mine in an Ally savings account, which is around 2%. Some people, depending on your risk tolerance, some people keep some or all of it in stocks and bonds. In my 2019 goal strategy, I referenced a study from Betterment, and they are advocates of, or not advocates, they published a study of keeping your reserve funds in a 40% stock, 60% bond, like index fund. And they say if you need 6 months worth of it, overfund that. I forget what it was. If you need $18,000, fund it by $22,000, so overfund it by a couple $1,000. Because as they ran their simulations, hardly ever would that balance ever fall below the $18,000 you need, but therefore you're getting like a 5% in return. So that's some other stuff to keep in mind. And I actually layer mine. I keep a certain percent in the savings, which is a lot in savings, and that's just where I'm at in life with having 2 kids and a wife, and I'm very risk adverse right now. So I keep a lot of cash on the hand. And yeah, I'm missing out on probably a couple $1,000s a year in interest, but that couple $1,000s a year is not going to make me. I'm worried about something that could break me, and so I keep a lot of cash on hand. Then my next stuff is layered in some stocks and bonds and some more layered in that stuff. So it all depends on what you're comfortable with and what accounts you have and all this other stuff. So start figuring that stuff out. One thing I will say is that lines of credit and credit cards and HELOCs, they are not true reserves. So there's that old saying that banks will lend you money when you don't need it, but when you need it, they won't lend you the money. Go talk to a lot of real estate investors back in 2006 when they had huge equity and huge lines of credit. Well, once the market started going sideways, banks actually closed those lines of credit. And a big thing I've heard from talking to people, the people that survived it, they had cash in the bank to handle things. The people did not. They were over leveraged and relying on lines of credit. They lost one property and then the whole domino effect. And I've got a similar story. Not in real estate, but when the world fell apart, I don't know if you guys remember when the money markets were actually they got frozen. Money markets are generally considered incredibly safe, but the institutions could not keep the money markets open. When the whole financial crisis hit, I had my small business American Express, my platinum credit card or my charge card. You can even carry bounce on it. It's one of those monthly charge cards. Use it, pay at the end of the month. My business partner and I had it for years. Went to use it one time, got denied. Damn it. We got fraud. We got to go through the hassle of getting a new card, a new number, updating with 30 vendors and websites. What a pain in the butt. Call up American Express. Long story short, they say, oh, no, your card's frozen because you're a high-risk small business. So once you send us the last 3 years, your tax returns and these bank statements will unfreeze your card. Well, we had cash in the banks. We're like, yeah, F off. We're not going to do that. But that taught me that lesson, never to rely on credit. And I started keeping more cash in the bank after that experience. I was like, oh, that can happen. That does happen. All right, I'll rely on myself. All right, so enough about the personal foundation or personal financial foundation. Hopefully that gives you some good idea on there. The next thing you'll want to do sooner rather than later is lending. It is one of the most important and also one of the most boring aspects of buying real estate. It's no fun getting all that paperwork together and then being, sharing all your finances with them. It's just not fun. I'll admit that. And most of my clients are that way, but it's a necessary part of the process because very few people buy rentals with cash. So if you're serious, you must get this in place. And I recommend working with a local lender, someone that knows the investing game and not just chasing rates or the best terms and not using one of the online lenders, just because you want that relationship. And ideally, you want someone that understands lending because it's not just about buying one property, because most lenders are great at doing, traditional loans for your primary residence. But you are going to want to buy a house now, then a property a year later, then hopefully 2 properties a year after that. It's a chess game. So work with a local lender you can establish a relationship with, and they can help you do the right planning so you can go out there and qualify for the best loans for not just this property, but number 2, number 3, number 4. So if you need any recommendations, always reach out to me. I can definitely share a couple lenders with you. So talk with a lender, and I recommend go ahead and have them pull your credit. Let them give you the full pre-approval. And Google and ask the questions on how much them running credit on you is actually going to ding your credit score. It's usually like 0 to 2 points. It's not a huge deal. But that real credit check gives you a real pre-approval, and it really gives you that great reality check so you know what you can or can't do. So I always make my clients get pre-approved with lending as one of the very first steps, because looking at properties, doing modeling, it's all kind of, oh, this looks good, but it's dependent on your lender. And just because you think you have great credit and you're a great borrower, that's not the same thing as a lender saying, oh, yeah, we will loan you this amount of dollars. So I always recommend you get that reality check sooner rather than later, because if it's not working out, great. They can help you figure out what you need to do to get in there. Or it might be, you know what, they might not be the best lender. Rather than going with a conventional lender, go talk to some local banks or come explore some of these other loan programs that may be a better fit for you. So talk with a lender sooner rather than later. All right, one of these final thoughts I want to talk about is how much buffer do you need? And buffer is how much, if you want $10,000 a month in income, how much extra income do you need to account for just reality and more higher expenses or lower rents or whatever happens. I don't have a great rule of thumb for you on here, and a lot of it just depends on your overall assets, but I recommend one. But if you're at 0 properties or 1 properties or 2 properties and you're, want to get to 9 properties, I wouldn't really lose sleep over it. I would really get focused on this once you kind of hit that first goal. If your goal is to get $10,000 a month in income after the properties are paid off, well, I'd really worry about this once you get to $15,000 in gross rents. Like, okay, great, I achieved this goal. Then you can stop and look and say, great, how are these properties performing? Do I have any properties that, man, one's kind of a dog I want to sell, or wow, one has huge equity, I should sell it, trade up, and I'll get, more that way. Or you might be like, you know what, my goals have changed, I need more money, I actually need less money. So I recommend one, but don't put the cart before the horse and worry about it now. Worry about it once you get closer towards that final goal is my recommendation. So I can tell you my personal goal, because my goal is actually not to have $10,000 a month in property in income after mortgage. It's more that $13,000 to $15,000 a month goal is what I'm shooting for. And so I really want $20,000 a month in gross rents. So some people want $10,000 a month, and they say, great, I'm going to shoot for $20,000 a month to help buffer it and also help pay for taxes. I have a true $10,000 a month in income afterwards. So there's other ways you can slice and dice this, but I do recommend a buffer. But if you're early on, don't lose sleep over it and don't get all caught up. Worry about that once you got a couple of properties in your belt, a couple of years of managing them, and once you get really closer towards your goal, then it's time to reevaluate that. Plus, you can evaluate it with other assets you have, because I think most people, they are investing in the stock market or we'll have Social Security, all those things. So as time goes on, you can see how these other assets you have are performing or are not performing. Okay, so really quickly, I want to talk about accumulating versus paying off your current properties. So those 4 steps are first one's creating your plan. Step 2 is accumulating. Step 3 is paying down your debt. Step 4 is retirement. So if your goal is to go out there and get $10,000 a month in income, well, that means you need that $15,000 a year in gross rents. Well, if you want to get to that goal as quickly as possible, which most people do, every model I've run, everything I looked at shows you should never prepay debt on your existing properties, or you should never take out a 15-year loan. If you want to accumulate those properties as quickly as possible, put everything on a 30-year amortization, and then take all the cash flow plus your monthly savings to buy the next property and accumulate more. And then once you get to, what we said, I think we said 9 properties, using that first example of, you need 9 3-bedroom, 2-bathroom condos in Aurora. Well, then once you get that 9th property, then you go from accumulating, then you go to debt pay down, and that's where you take the cash flow and your personal savings and pay down the debt. But of course, even then, kind of going back to what we talked about with your buffer, you may want to buy more properties. Or you may say, great, my real estate's going well, but man, I want to put more in the stock market. So rather than paying down the debt, you put more in the stock market. So my personal strategy and my advice to most of my clients are accumulate before you ever prepay any debt. Because you'll always get, not always, you usually get a better return by buying properties than you will by prepaying debt at 4% or 5%. You're not getting a huge return on that money. And if you do want to pay it down, then you want to do the debt snowball. And the debt snowball is take, the smallest loan balance or take one property and take all the cash flow from all your properties and put it towards that one property, then pay off that one property quicker. And then move on to the second mortgage, the third mortgage, the fourth mortgage, and do it systematically. And again, I'll be doing more modeling on this in the future, but just right now, plan on accumulating before you pay down any debts. All right, one last thing to think about. I think it's one last thing. One of the final things to think about is your retirement timeline. What is your target date? We all want to retire at different dates. We all going to have different goals. So a lot of the variables will impact on here, and that's going to be a lot of even non-real estate stuff. Just what's your timeline? How are your other assets performing? What's your job like? What happens in your personal situation? Do you have major medical bills? Do you have a bad job? Do you go through a divorce? Do you start a family? All these variables are going to impact your timeline and your savings rate. So it's really hard to give you a rule of thumb here as far as like, if you have this amount of money now and you buy these properties, you're going to be able to retire at this date. So I can't really give you a rule of thumb on there, but I do want you to kind of let you know that I am thinking about it and that you should as well, but that's going to be the hardest thing to model as to what your retirement timeline is. But we do have some additional resources coming out sometime in the near future that will be talking about this. So I do have some specific scenarios that will cover, buying properties, accumulating really fast, and then turning to debt pay down. So you'll see a couple examples like that and how it impacts it. And actually those will be covered in that investment property analysis course. We'll have a couple in there. And then also there'll be some future content covering there as well. And if you want to get more detailed to your specific situation as far as your savings rate, your timeline, and playing around with assumptions, you may want to use the real estate financial planning software for some very detailed modeling. Now, I would not recommend using a software until you have your strategy in place, which is this basic stuff we're talking about now, because a financial planner, it is heavy duty. It is detailed. There's a learning curve to it. And if you can answer the questions we talked about the last hour and so, you're not going to be ready to have your data in there for financial planner. But getting all this stuff figured out will set you up so you can go in there and use a financial planner. So I'll be putting more content out on using that software to do some really advanced modeling. And then also James Orr, who is the creator of it, I had a phone call with him the other week, and he's talking about hosting some webinars or some in-person trainings on walking people through creating their own plan, just because it is such a steep learning curve. And and he lives in Fort Collins, so the in-person training should hopefully be somewhere between Denver and Fort Collins or a webinar. He has no exact dates or plans yet, but I know he wants to get this information out to people and help them learn to use it. Because, the software, there's a lot of data you have to put in. You have to learn how to use it. And so he wants to do training out there to help people do it. So just keep your eyes open on the email list on this podcast for future scenarios that I will cover. And when James holds some trainings on how to use the software, I will definitely kind of keep you guys in the loop as well, because it's a very, very powerful resource you can use to do that detailed, personalized planning. But like I said, get this basic stuff in place first on your strategy, because that will set you up for inputting the data into the software or understanding some of the scenarios that I run in the future on here as well. All right, so here's what we're going to wrap up with. I'm calling it the reality check, which is just going to be me asking you some questions, and then you should be putting down answers. And you can do it on a Word document. You can take a screenshot of this. I will put in the show notes for this blog post so you can grab it from there. So you have to ask yourself, what is your monthly cash flow? How much cash flow do you want for your retirement planning from real estate? Then, using a 33% rule, what's the gross rental cash flow you need? So take the cash flow you want and divide by 0.666, which will give you the gross cash flow. So, we talked about the $10,000 cash flow. Divide by 0.666 gives you $15,000 in gross cash flow. Or use whatever rule you want for operating expenses. Now you want to figure out your annual gross cash flow or your NOI. And actually, that should not say annual gross cash flow. That should be the annual cash flow you want or the net operating income. So annualize it. So take that cash flow you want. If you want $10,000 a month, annualize it, multiply it by 12 to give you $120,000 a year. Then determine the total property value needed to kind of give you a roadmap to how much property you need to buy. So take that goal, that net operating income, and divide it by the market cap rate. If you're in Denver, you're not sure what to use, just take that goal and divide it by 0.06. That will give you a really good rule of thumb, or at least give you a ballpark for what you need to buy in the current Denver market with the type of rental property you're seeing. Some properties will be higher cap rates, some will be lower. So take that annual net operating income, divide by the cap rate, or by 0.06, which is 6%, and that will give you the total amount of properties that you need, or the total property value you need to buy. Then write down how much starting capital do you have. Once you get your personal financial house in order, you say, great, here are my reserves for my 6 months. Here's what I've got for this. Here's the money I got to the side so I can actually go out there and buy real estate. Write down your starting capital. Then determine your monthly savings rate. What can you save on a monthly basis to fund future real estate investments? Now, if you own any properties, list them all out. Just write them all down or put them in a spreadsheet. And this is both your primary and any rental properties. So write out, this is not an inclusive list, but you'll get the idea. Write out what you bought it for, how long you've owned it, the loan details, what's the loan balance, what's your monthly payment, what do you think it's currently worth, what's your monthly cash flow, what's the equity you have in there. And then you can sit down and figure out some options you have on there, because you might be able to do what I did, extract equity from your primary or extract equity from a rental property, trade up to go buy more rental properties. But you need to write it down so you can figure it out, or sit down with me or someone else to figure it out. And really have a serious conversation with yourself or your spouse or your family. Is buying a nomad property or buying a house hack, is it an option? Even if it's just for once or twice, is it an option? Because it's going to have a major, major impact on your retirement one day. And then talk with a lender and then get your lending pre-approval amount. What are you pre-approved for? Because that will determine how much property you can buy. And then what's your timeline? When do you want to realize this cash flow by? Great, I want $10,000 in cash flow. Oh, you want it in 5 months? That's not realistic. Oh, you want it in 15 years? That's very realistic. So write it out. And then just write out what you think you need to do as far as actions needed to buy your first or your next place. This might be stuff, education stuff you need to learn. You might have some hesitation or considerations or some friction points. Great, write it out. Do you have a roadblock that's stopping you from doing something? Great, write it out. Like, what needs to happen so you can go out there and pull that trigger. Okay, so to wrap things up here, what is your strategy? Listening to this or watching or reading this is great, but writing out your own strategy is very, very powerful. So I recommend you figure it out, then you write it out. Now, if you need help on creating your strategy, because I went through a lot of numbers here and then putting together the bigger picture, that's one of the things I do as a real estate financial planner. Reach out to me. And I'm happy to do this. If you are a client or you want to be a client, I'm happy to sit down with you and do a consultation. So email me or go to denverinvestmentrealestate.com/consult, CONSULT, and there's a form on there you can fill out, just name, email, and a couple questions, and we can sit down and help you do this stuff. But it's only for clients or people that want to become a client, because long story short, I don't do these. I don't charge a fee. I don't do these for people that aren't clients. It's just a value add thing I do for my clients. So if you need help, definitely reach out to me, or dissect all this information I gave to you and these other resources we have and create your own strategy. Lastly, this is the big thing. Write out your strategy and then submit it to get it published in the 2020 edition, or whatever edition of this thing is being recorded and you're listening to it in the future, into the next edition of the Denver Real Estate Investing Strategies book. Hopefully most people listening or watching this have read this book already. This is a book I published in, I think, May or June of 2019 as a first edition. And it came from kind of my personal obsession with financial planning and writing out strategies, and also my belief in that writing out your goals and your strategy is way more powerful than just thinking about it. Because if I can write it out, and I have to write it out so someone can actually read it and understand it, that's going to make me have really good clarity in my mind, which allows me to execute better. So I did this book. The main one is for a couple reasons. One is so I could actually write out my own stuff to hold myself accountable and make me perform better. That was the number one goal. It's a very selfish goal, and I'm not shy to admit that. because I know if I publish it, I'm a lot more likely to achieve my goals, and that's the most important thing to me and my family. The second thing is I wanted to read what other people were doing. So I got, I think, 19 other people around Denver in this first edition to write their strategies. It's always fun to read and learn from others. And then the third reason is I want people to go out there and write their strategies. Whether you're my client or you're not my client, write your strategy and publish it. For all the reasons I just talked about, you'll get more benefit from it by writing it out. Okay. So with all that said, that is the final things on my notes here I wanted to cover. If you got questions on here, reach out to me, put them in the comments. If you need help putting the strategy together, definitely reach out to me, email, or go to denverinvestmentrealestate.com/consult for any help. All right, everyone, thank you so much.